Glad to see everyone here. We've got a big crowd today, which just says to me that value in the company that you're building is really important to people, and that makes me happy. It's my favorite thing to talk about. I appreciate your patience. For those of you that were registered for last week, you'll see that our presentation says Thursday of last week. I am 95% after a little bit of issue and illness, and hopefully I can get through this hour without a coughing break. But if I need a 30-second break, I'm sure you guys will be gracious and give it to me. But happy to be here. Hope things are going well with everyone and have settled down a bit since school started. I know it's a very busy time of year, so taking your hour to be with me is greatly appreciated. And I will honor that and try to give you as much information as possible. We'll stop 15 to 20 minutes before the top of the hour to give you guys a chance to ask questions. This broadcast will also is being recorded and will be available on our website by tomorrow, along with all of our series. So this year's series is on succession planning. I want you guys thinking about your future way before your future thinks about you. And I want you to make plans, know what your options are, know what you need to do for your future in being as financially healthy as possible and creating as many options for yourself for the future exit. You will exit one day, as will I. If you're like me, when I hear that, I'm like, what? No, they're going to bury me out back. But we will exit our businesses at some point. So we want to do that in a way that takes care of the people we've created the business for and ourselves. And also, along the way, financial help is required for you to operate the type of business that you got into this industry for. So they're not diverse, they go with each other, and they're not possible without each other. So that's my frame of reference always as I talk to you guys about financial and business concepts in the future. So as we go, you have a question bar that I believe is at the top or the side of your screen. Is at the top on mine. Feel free to put questions in as we go. We'll keep an eye on those. And then also we will, like I said, stop at the end to take those questions. So what do we have in store today? One second, technical difficulty. There we go. All right. You don't want me doing your technology. You want me doing your business and financial planning. Someone else has to handle technology. Okay, here's what we have prepared for you today. I want to tell you about a few things happening and a couple of opportunities coming up at Hinge. We want to look at the big picture of value for businesses. I'm just going to go ahead and say now that to value a business is very, very complicated. And it hinges on a lot of different factors. And some of those are outside of your actual company. They relate to who the buyer is and what the buyer's objectives are. So it's a very complicated process, but I want to talk about the basics of it because I want you to hear the terminology and understand the basic concept. And then every company is very different, and every company is viewed differently by different buyers. So your value with one buyer could be different than the value from another buyer. So we'll talk through the concepts. Then I'll go into a little more detail about each of the steps and how they work, and then tell you a little bit about what's happening next month, which is real estate valuation. So that's where we're headed today. We can see this is going to be a fun hour already, right? Okay, first of all, a couple of announcements. We're so excited for our third annual business conference Shift, which is planned for Miami Beach in February. So if no other reason, Miami Beach in February is fabulous. We opened registration a couple of weeks ago. We had a super early bird for a week. 120 people registered. We were very pleased with that. So we're in our early bird pricing now. We do limit this conference to 300, and we have sold out every year until now. We like that size. We try to make meaningful opportunities for people to connect. We want it to feel good, and we want you guys to get a lot of attention. So we have historically kept it at that number and plan to do that again this year. Let us know if you have any questions. We've got a great lineup of speakers. Our conference celebrity keynote is Greg McEwen, the author of the book Essentialism. It's been one of my favorite books of the year, so I'm very excited about that. Our industry keynote is Joe Kirshner, the CEO at Primrose, so we're excited to hear from the franchise community. We have 5 really dynamic shifter speakers and some great content. So again, if you have questions, reach out. We would love to see you there. You can find that, here we go. You can find that at shiftchildcareleaders.com. There's also a link from our website, our Hinge Brokers website. Here's an announcement on a closing. It's been a crazy year and a very great year for the Hinge team and its clients. There's a lot of aggression in business purchases, more so than I've ever seen in my 34 years in this industry. We are very interesting to the investment world. That makes me excited for our clients. There are a lot of international groups trying to get in the U.S. All of the U.S. groups are in big growth mode, so there's a lot of competition for quality assets. And then some of our smaller groups and even single sites are in growth mode right now. So a couple of weeks ago, we brought a new provider from the UK, Busy Bees. They operate in several countries, but we're not in the US, and we sold them a 20-site group based in Connecticut to bring them into the US and have more demand for things like that. So just a frame of reference for this business valuation and where we're coming from. There's various predictions on how long this aggression will last. Nobody knows for sure. I'll be the first one to say. The predictions are 6 to 9 more months. A lot of our buyer base believes that we'll soften a bit right before the election. Who knows what will happen after that, but they have all said to us that they expect the next 6 to 9 months to be very aggressive for them, and we're seeing evidence of that. We just got offers yesterday for a smaller group. They greatly exceeded our expectation, and I think we have a pretty happy seller. So interesting time in business valuation. A couple of other chances to see our team in the next month. Our group in California, Mike Pepper, Kathy Petchel, and Molly Petchel will all be at Every Child California in next week. We have Kathy Petchel going to Pennsylvania for the Early Childhood Education Summit in a couple of weeks. Excellent conference. If you're in that area, go see Kathy. Kathy and I will both be presenting at the Virginia Childcare Association on October 25th in Richmond, so we're excited about that. October is a big conference month, so is November, but we love it. So we're happy to get out. We'd love to see you at some of those events. And if you are in the area but not at the event, reach out and maybe we can find a connection that way. So let's look at the process and the basis for valuing a business. We get a lot of comments from our sellers and clients at times about the way that the process or the valuation should be. I think the valuation should be based on the number of children in the schools. I think the valuation should be based on the number of license capacities. I think it should be on gross revenues. I think it should, which is all great. But there's only one way that buyers in this industry or other industries that I'm aware of value businesses. And theoretically, it's based on how much cash flow they're going to make on that business after they buy it. And so I'll tell you how they get to that number. But logically, if you think about it, they're interested in their return on investment. So if you guys are investors in anything, if you have a mutual fund, if you have money in the stock market, if you're a real estate investor, you'll understand that when you put your money somewhere, what you want to know is how much money you're going to make on your money. Is it 8%? Is it 2%? Is it in the bank at 0%? How much money will you make on that money? So same thing for business buyers. What's in their head is, I'm going to pay X dollars for this business. What is my cash flow going to be after I buy this business? So keep that logic in your head. Think about it from a buyer's perspective. And let's look at the methodology we go through when we value a business. Okay, so this is the process at a glance. These are the steps that we go through when we look at a client's business and help them determine the value in the marketplace. So the first thing that we want to do is look at the current financial performance. So again, remember that we're going to base value on the amount of cash flow that business can generate after the sale, but we're going to start with the amount of cash flow it makes right now. And by right now, it doesn't mean in October of 2019 that we're going to look at 2018 numbers. That used to be the case in my life, maybe 10 or 15 years ago. But we want to look at the most recent 12 months performance. And it really has to be the most recent 12 months. It's very difficult to take the first 9 months of this year and then annualize that for 12 months, because we have so much variability and seasonality in our industry, as you know. So if your best months are the spring, as most people's are, it wouldn't be logical to take the first half of the year, multiply that by 2, and think that that was logically what you would do in a year. So what we would start with, if we were today in October, is we would ask you to give us your financial performance from October 1st of 2018 through September 30th of 2019. You will often hear that called a rolling 12 financial statement. All that means is it's rolling to current. It's not a calendar year, which is January to December. It's not a fiscal year, which if you have a different year end than December, maybe it's May or October, that's your fiscal year end. A rolling 12 financial statement is the most recent 12 months. So most systems can produce this. Most of our clients operate from QuickBooks, or they have an outside firm that produces their financial statements. At any rate, refer back to our masterclass earlier this year on the things to do in advance, and we put a strong emphasis on financial information. So all of those are still available on our website. Be sure to catch up with those before you get here, because some of those pieces are important before you get to this point. So we have to start with what you're making today. Another thing that we get conversation about sometimes is, but the new buyer could do so-and-so. Yes, they could do so-and-so, but they are going to have to put the resources, time, money, and energy into creating that. So if you have not already created it, you will not get value for that. Buyers typically want some upside. So in their perfect world, they want a profitable business that they can make more profitable. They like also businesses that are at maximum profitability. So I don't want to say that that's not a thing. We have less interest today in businesses that are troubled, but there still are some companies that specialize in turnarounds for companies that are troubled. But you will not get value for what you have not created. So something to think about if you have a 2 or 3 year plan is put the plan in place to create that. If you know that there's a business opportunity that would improve your financial performance, maybe you choose not to do it. That's okay. Everything's a choice, right? But if you want the value for that, create it, show the numbers. Excuse me. If we have schools that are not mature, so they're new schools, they could have been schools that you built. I'm on the second bullet now. They could be schools that you acquired from another operator, but they're not at maturity. And maturity is a couple of things. Maturity is where you project yourself when you're at your most profitable in that school, or 36 months is kind of a rule of thumb. In today's market, most people get to maturity a good bit before 36 months. So you will typically get to 70 to 90% occupancy before 36 months. But buyers consider schools that are 36 months old to be mature. If we are selling a portfolio of schools, not just one, let's say we're selling 3 for a seller, and one of those schools is not 36 months old and it has not gotten to the financial performance we expect it to get to, then we project that school out. In the past, several things happened. So long ago, you would get 0 value for that. Then we moved to a place with more aggression where you would get a future payment for that, typically called an earnout. We're not always fans of earnouts. I typically say to clients, be happy with what you get at closing, be happier if you get a future payment. And the reason is you're typically going to go away after the close, so you have no control over how that school will do. More recently, we've had enough aggression that we have clients getting value at closing for the future performance of that school if it's showing the trend of ramping and is less than 36 months old. So we project those schools out. And we do it in a method that we can support based on your history and how schools ramp and what we know about how schools ramp. So there's a specific methodology around that, but just know that if you have new schools in the mix, you can get value for those. Bullet point 3 is that we want to adjust to go forward EBITDA. So let's talk about that terminology first, and then we'll talk about how we do that. EBITDA is a fancy term that us accountants like to use to make ourselves sound smart, because we have to do something to make ourselves sound smart. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. All that means is cash flow. I want you to hear that term and know it as you begin your succession planning. If you ever buy a school, if you ever sell a school, you will hear the term EBITDA. You might also at certain times hear the term EBITDAR, same thing with an R on the end, which means before rent or mortgage payments if you own your property. So excuse me. In that case, the buyer wants to know how much cash flow is available to pay the rent and other expenses. So how are we going to take your numbers, your most recent 12-month numbers, and adjust those to go forward EBITDA? And when I say go forward, I mean so that we say to the buyer at closing, here is what your numbers will look like. So our process goes through presenting your raw data, making any adjustments that will change at closing, and we'll talk about some of those, and then presenting, here's your future cash flow that you should base your price on. We'll get into a little bit more shortly on what that adjustment looks like. Then some of the adjustments are if you are an owner and you have personal expenses in your business that will not be replaced after the closing, I'll explain that. then those get to be, it's called an add back. So let me say this because it can be confusing. We're adding it back to the bottom line. Basically what we're doing is removing that expense, but it's typically called an add back. So I want you to be familiar with that term. When you hear add backs, just know that those are expenses that will go away after closing, so that makes your numbers go higher, right? So we account for owner expenses. We make other adjustments, and I'll go through what some of those are, and then we apply the multiple. I'm going to hang on to the multiple thought until we get into the detail and talk a little bit more about that. So let's dive into those things in a little more detail. Okay, first of all, like I said, we're going to start with the most recent 12-month financial statement. The only things that I have to add to this, other than what you heard me say already, is that I prefer an accrual-based system as opposed to a cash-basis system. A cash-basis system would be to record the income and expenses when they're received and when the expenses are paid. In an accrual-basis system, you record the income when it's earned and the expenses when they're incurred. And here's some things that trip some people up and might skew their numbers. If you have a lot of people that owe you, they're not in your center over Christmas and New Year's, and they didn't pay you for that, and they come back in January and pay you, but that was really for December. So you might be missing that in the December revenue. Another thing that throws revenue off is subsidy payments can be large. And sometimes they're not always received timely. So that can throw off income. Things as simple as utility payments. Think about at home or at your business, what utilities you're using this month, you will not pay for until next month. So those are simple things. We can give you more information about financial statement presentation and accuracy, but what we don't want is to get into a process and then find out that there was something we left off the table for you because your financial statements were not presented correctly. So get plugged in with us or somebody else, or get plugged in with a great CPA. I will also say that I see them make mistakes at times too. Just be sure your financial presentation is solid and you can base your value on it. You guys see me. I'm trying to keep you from listening to me cough, but I have to put the cough drop in my mouth at times. I was determined not to put you off for another week, so thank you for bearing with me. I think we talked about this well as we project the ramping schools to maturity. Here it says as the basis for a potential future earnout. And again, last year even, that was the best we could get with a ramping school. This year, we're seeing the aggression into getting cash at closing. So a little bit of a market tweak there. All right, next thing we're going to do is adjust to the go forward cash flow. Like I said, here's your definition: earnings before interest, taxes, depreciation, and amortization. Nothing more than cash flow. We're going to add back the owner expenses. So what could some of those things be? Let's talk through those a little bit, because we get a lot of questions from owners about their personal expenses that show up on their financial statements. And rent is one of those that I really want to talk about. Some of those things could be, generally an owner will be paying themselves a salary. You can pay yourself as much as you want, or you can pay yourself nothing. If you are not the director of the school, then your salary just gets added back. So that just increases the bottom line and the value for your company. Because in our world, well, so let me pause right here and talk about the different types of buyers. At Hinge, our processes and our transactions typically go to companies that already operate. So there's several different types of buyers. You could have an individual buyer, and maybe that individual needs to continue to make that salary. In that case, you wouldn't add that salary back. For Hinge and our clients that are good targets for larger companies, unless you're the director, we remove that salary, making you more profitable. If you are the director and you're paying yourself under market or over market, then we have to adjust that number to what a market director would make, because the new owner will have to hire a director to come in. So again, they're going to adjust what you're paying yourself to what they're going to have to pay so they can figure out their cash flow going forward. So salaries is one. Personal expenses like telephone, cars, travel, are typical places, benefits, are typical places that business owners use their company to pay for expenses. But if they're related to you personally, that's fine. We just need to be able to show documentation around it, but those come out. Rent is one that we have most of the conversation about. So let's have a conversation now about rent. Next month's workshop will be completely on real estate valuation, but the two go hand in hand. And when I say rent, in a typical business, either our business owners are paying rent to someone else, which is pretty straightforward. They have a lease. This is the rent amount. That typically would not change in a process. If the business gets sold to someone else, they're still required to pay that rent to the same landlord, so the rent would not be adjusted. If our client owns the building, it's typically held in another company that they pay rent to themselves, or they make the mortgage payment within the company. But more typical, again, is a separate company that they own and pay themselves rent. We get the question a lot, similar to salaries: what should I pay myself in rent? What if I pay myself too much? What if I pay myself too little? And the short answer is it doesn't matter at all for valuation purposes. What it matters for is income tax preference. So the best person to tell you what rent to pay yourself is your CPA. It's only a matter of which entity is best tax advantaged. For valuation purposes, you can pay yourself zero rent or every penny you make, and we're going to adjust it to a market rent anyway. The reason we do that is that once a business buyer buys your business, we want to show you two things about your real estate. Here's what a business buyer would pay me in rent, because they're very specific parameters. That's next month. Or here's what the real estate market today would pay me for my real estate. And so we want to show you both options, the rent and the sales price. That math is not real difficult today. They're very specific criteria that business buyers use, and some very short, narrow benchmarks that people want to pay in rent and that they want to pay for real estate to get the return on their investment there. So the way these interplay, of course, is that as we adjust that rent upward, that increases expenses and your cash flow decreases, meaning your business value decreases. You'll hear this from me this month, and it's actually in 2 weeks. So it's not next month, it's October, but in 2 weeks at the Real Estate Masterclass, that when we can, we put as much value toward the real estate, knowing that we might sacrifice the business value, because you get more value from your real estate than your business. Your returns are higher from your real estate than from your business. So knowing we might increase the rent would compromise the business value. Sometimes people are paying themselves a little over market rent, and again, that's okay. But for valuation purposes, we might have to hold that down to a value that the industry can tolerate that will increase your business value. So these are very delicate maneuvers. But in today's world, it's pretty predictable how we do our real estate. And that's been the most easy part of our work the last couple of years. So rent is a typical adjustment. But as far as owner expenses go, typically salaries, benefits, rent, insurance, autos, travel. Those are typical owner expenses. And again, they're very usual and not a problem. So that's the next step. Now we want to make other adjustments. So here's where it gets really tricky, and you'll see it my parentheses at the bottom. Here's where it takes knowing your buyers really well, and not just your buyer pool, but each individual buyer, what they spend where, and how they're likely to make adjustments going forward. So this is where it's really important for your broker to understand the people that they're working with to possibly purchase your business and how to maximize that value. So here are some other adjustments other than your personal expenses. I mentioned rent. It's really a personal expense, but it's mentioned here. Benefits. So benefits from a different perspective here. It's possible, and this is typical, for a smaller company to have less employee benefits than a larger company. Typically, a smaller company will not have to comply with the Affordable Care Act. A larger company will. They'll put in health insurance benefits or other benefits. So typically, a larger buyer will add in benefits that a smaller buyer doesn't have. So again, think like they think. I'm going to pay based on this cash flow bottom line. I need to know what my cash flow is going to be after we close. I'm going to have to spend more money for benefits. Maybe you think I would have to spend less money for benefits, but that makes me really nervous because this is another webinar, but I never want to take things away from people in a transition. People are your key. And your number one and probably only job is to make the team happy in a transition. That's another masterclass, like I said. Your management expenses might change. For instance, if I have a 3-site group and they're being acquired by a national group, they might not need some of the management expenses, the outside accountant, the legal team, and maybe even some of the internal management that manages all of the schools. They might be able to plug those schools into their system and it costs them less money to operate. It might be the other way around, that they're in a new market and it will cost them more money to operate. But we have to know who they are and how they would look at those expenses, and they will make that adjustment. Property taxes is something that often changes. A lot of our sellers do not pay property taxes in their business entity, but we will put those into the business entity because we want the new tenant to be responsible for those. So a little complicated. That's going to go with next month again, related to your real estate. But when we sell your business, we want you to either be a landlord with as little responsibility as possible. So we want the new business owner to pay you rent, pay the property taxes, pay the insurance on the building, and do all the repairs as much as we can. Sometimes on older buildings, a new tenant will ask you to be responsible for major things, the structure, the roof. But on newer buildings, sometimes nothing. But the game for us is to get you responsible for as little as possible. So if property taxes are being paid somewhere else, we have to then put them into the new cash flow projection because we want that entity to be responsible. So again, we're showing them what their financial picture is going to look like after closing. Maybe their insurance costs, typically with a bigger company, their insurance costs are less. It's just the way the world works. Healthcare is another one that I mentioned as far as benefits go. So it's complicated. And it's difficult for me to list everything here. I wanted you to be familiar with the fact that the buyer will make, and you should do this too. If you're, I'm speaking to this as if you're a seller, you could also be a buyer. So think about this in the same way. Make any adjustments to the numbers that you know will change after you buy it. Some of your expenses might be more. You might spend more on educational supplies. You might say, there's no way I'm spending 8% on food. I can do that at 6% all day long. So make that adjustment. You want to know what you're going to make on it going forward. So those are our other adjustments. All right, now we're going to apply the multiple. So what is a multiple? A multiple is just a number that we multiply the cash flow by. So let's talk about this logically. Up until this point, we've talked about the cash flow going forward that the buyer will earn in a year. So think again, back to the beginning. I'm going to invest some money in your business. How long will it take me to recoup that money? What kind of return on investment will I get? I want to know how long it will take me to actually make money off of this business. So I am going to multiply the annual go forward cash flow by a number, the multiple, that will give me the business value. What's included in the business, the goodwill, meaning the parent base, the revenue source, the teachers are in the building, you've created the business, so there's goodwill. There are hard assets in your equipment, your vehicles, your furniture and fixtures. So the business buyer is acquiring all of the assets that it takes to create that cash flow. So the business value includes all of that. And typically it's, you know, especially if you have a cash flow business, it's much more than the hard assets. So the number can get much bigger than what you paid for equipment, furniture and fixtures and vehicles, because you're getting paid for the goodwill you have created that is creating that cash flow. So we'll talk in a minute about where multiples are today. Multiples can be very complicated. So again, I'm going to give you some of the factors that go into our thinking when we apply a multiple. Variables on where the multiple is how many schools do you have? So the biggest increase in the multiple is from 1 school to 2 schools. Big increase there. Then, of course, as you get more and more schools, and I'll talk about where multiples are by size of company in a minute, and you'll see that it increases the bigger your company is. So the more schools you have, the more attractive it is to buyers, the more valuable it is. The second thing is demographics. So we have different buyer bases that prefer different types of schools. There is a huge buyer base for private pay, higher level demographics. That's an easier one. There's also a pool of buyers that not only are okay with, but prefer subsidy schools that might be in lower demographic areas with a parent base that's a lower demographic group. So neither are a barrier. But typically, a private pay, higher demographic company will command a higher multiple than a subsidy, lower demographic company. And let me explain that. Sounds like, you know, they're just being mean. Most investors consider a company with high subsidy to be a greater risk because most of their money comes from a single source. So it's typically our Child Development Block Grant Program on the federal level that flows through the states. And although that's been very stable, again, it's a single system. If it went away, some companies would go away. So demographics matter. The quality of your real estate matters. And I have really stepped up my coaching in the last 2 or 3 years with our clients on remodeling, improving the the quality of their real estate with a complete overhaul at least every 10 to 15 years. And here's where the risk comes in for most people right now. There is so much growth and new construction in the country that your risk is, if you don't keep up with this, new and shiny is going to come right down the street, and it appeals to people. It feels safer. It feels like your child will get a better experience. It's attractive. But we have sold 40-year-old buildings that looked 10 years old, because you have to make a significant investment in your building flooring, signage, paint, furniture. All of these things have a bearing on your value. So to make those investments are very important. We have a complete masterclass on this as well. We have some partners doing some beautiful work in branding and remodeling. We're happy to get you guys connected if this is something you're thinking about. We also have some strategies, if you don't own the building, for working with the landlord to make improvements and then maybe add a little bit to your rent. And we believe you can more than recoup that in tuition rate increases and occupancy. So the quality of your real estate is very important. The quality of programming a system. So let's talk about programming first. And what I mean by that is operations, your curriculum, your teacher quality. If you guys are hanging with me for most of my content, you will know that I believe there's no place in this industry for meh. You really have to be a solid provider to do work in this industry. Are there still people who are not quality providers? I hear it. I don't know them. I think that most everyone does a fabulous job with their curriculum and quality of content. But I almost feel like you have to have a sizzle factor beyond good quality curriculum. You guys have heard us talk about some of the sizzles we think are going on in the industry: STEM curriculum, language immersion, sustainability. We love outdoor classrooms. We like, there's some things that make you special in a market, and parents love special. And you're probably already doing some of these. Be sure that you're marketing them and communicating them well. But quality of program makes a difference in your value. Quality of systems makes a difference. So at the very least, as far as internal systems go, you need to be using a computer-based system to bill your parents, keep up with databases, produce information, because this is critical in a process. Also something you want to look out for if you're acquiring a company. They need to be able to prove to you that what you're buying is true. It's easy to hand you a piece of paper with numbers on it. You need to verify that. So that comes in our diligence process. We have a series online about the process for selling, so you can refer back to that. In addition to those systems, a lot of our clients now have CRM systems. They have communication portals with parents. And a lot of these are becoming required to compete in certain markets. So pay attention to systems. Keep yourself current. I've never seen so much inflation so fast. So stay plugged in to where you know what the new trends are in the industry. Go forward management is important. So if a buyer will want to know that they have to make as few changes as possible. I want you to know as a buyer that if you buy a business, you are going to make as few changes as possible. So in my perfect world, the director doesn't change, the teachers don't change. You make them feel really good, and you say, we might work on some changes in the future, but we'll do them together, and they're cool. And the parents look at them and say, is this good? And they say, yeah, I think it'll be fine. That's what you want to do. That's the perfect world. If you have to change the director, know that you're going to knock it out of the ballpark. Don't be speculative about that. So goes the director, so goes the school. I look out for situations where the owner is the person with the primary relationship with the staff and the parents, and then they go away. So in a perfect world, again, the person with that relationship is still there after the closing. So go forward management and the stability of that management plays in as a factor to the multiple. So I say to people all the time, your primary job is to work your way out of a job so that you can step back and your business can operate with someone else without you. That's your primary job. And then we mentioned subsidy. I did a little bit of that in demographics. Excuse me. I mentioned subsidy along with a demographic base that is on the lower end of the spectrum. So it makes a difference in the multiple. So let's talk about where those multiples are. Historically, for years and years and years and years, we were an industry that was a 3 to 5 multiple industry. It's pretty low, and it's really not the case anymore. So let me talk about what's going on in the world and where the bar gets set and how that impacts what your company's worth. So I say this, funny to people a lot. When Childcare or Learning Care Group, which is the La Petite family, are near you and your competitor, you would love for them to go out of business. Why you might not want that to happen is those national groups and what they're worth sets the bar for what you are worth. So if they go out of business, the investment world gets nervous and then they're not investing in you. If they go out of business, you go to the bank for a loan and the bank is very leery of the industry. So the stronger we all are, the stronger we all are. So at the very top, the national groups, and if you guys get the top 50 list from Childcare Information Exchange like I do, it comes out in their January, February issue, you will see that from the largest, Childcare with about 1,600 schools, the Learning Care Group, the second largest with about 800, it drops down to a couple of hundred, and then real quickly, by the time it gets to 50, it's about 10 schools. So we're a highly fragmented industry. But at the very top, that top group of 20 trades every couple of years, and today they're in the 12 to 14 multiple range. You need to be 300 plus schools to be in that range, but what I'm saying is that group sets the bar for everything under it. If you are a company that, now we'll jump to the other end. If you're troubled in some way, if you're not making a certain level of revenue, you're struggling, there's something going on in your school that doesn't, these variables we just talked about are not completely in line, you might go under a 4 multiple. It has been a very long time since Hinge sold a company under a 4 multiple. So most of our single site schools that are quality schools in good markets and of size for our buyer base and doing the right things will be 4 plus. Once we get to 2 schools, you're getting closer to a 5. So remember that I said the biggest jumps from 1 to 2 schools, if you were just to divide it by schools. By the time you get to small groups, 3 to 5 schools, you're going to be in the 5 to 6 range. If you get up to, we've actually even had some small groups in the 7 range recently. That's how much aggression there is. If you get up to 10 to 30 schools, you're going to be in the 7 to 10 range. And then there's not much in that gap. So it depends on the number of schools, but also it depends on the factors we just talked about here in applying the multiple. So it's not an exact science. We have to know a lot of factors about each seller. We also have to know the buyers really well and what they want and how they behave and how aggressive they might be. On most of our larger transactions today, we are not naming prices. We're letting the market determine the price. And we're frequently pleasantly surprised that it's gone over the level that we set. So that's where the aggression in the market is that we mentioned earlier. So that's the multiple. Very complicated, but I like for you to understand the terminology and the concept. I'm going to say this just briefly, but this is the basis for next month's, second of this month's masterclass. Real estate is valued differently. So real estate is based on the rent that we mentioned earlier that the business can afford to pay. And I'm going to not say any more than that because I just checked the time and there's 10 minutes to go and I see we already have questions. So I'm going to park that. Real estate valuation can get a little bit complicated. What I will say is that often our sellers believe that the real estate is worth what the price per square foot their next door neighbor got. It would if the building was empty. If there's a business in it, that business determines the value of the real estate. And there's some very specific ways we measure that. So coming up next time. Okay, questions. I know you guys are piping in with some questions and I'm going to access those. I'm going to look ahead real quickly while you guys are putting your questions in. Here is October 17th. It's our next master class. Like I said, we will be talking everything real estate and we will try to make that as reasonable a conversation as possible. It's quite a complicated process and methodology, but we love to talk it too. So let me get over here to our questions. I'll pull that up. Okay, this is a good question. Does it matter what age groups you serve? Okay, so I assume that means, does the value matter depending on what age groups you serve? Good question. Most of our clients that have traditional early education companies serve infants through 12. So typical model would be infants from 6 weeks up to 4 years old in preschool. Some of those also provide services for 5-year-old kindergarten, and then they would serve the after-school community in the afternoon and summers. That's traditional, and that works within the parameters that I just talked about. Some of our clients also operate private school grades. Those can be K-5, K-8, K-12. Those typically command a higher multiple, not drastically, but if you have an elementary component, it brings down the number of buyers, but typically the multiple will be a bit higher. Some of our clients do not serve the infant and toddler community. I have not seen that have a big effect on the valuation. So a lot of buyers will see that as an opportunity. If the occupancy isn't maxed out, maybe we can serve infants and toddlers. From a financial standpoint, that doesn't generally help you. It's usually just a feeder program and a way to get siblings who are older, so parents don't have to go to 2 places. So, but I have not seen that play on the multiple. Another thing to think about is some of our clients operate after school only companies, and there have been so few of those transactions in the marketplace that I would say that there's not a strong precedence for that. The way I would market that at a multiple would just be to give it a go and let the market set the valuation. So there are 2 national players in that arena. And then a lot of our clients also serve that community in addition to the traditional early education ages. I have more than 1 school, but I don't want to sell all at once because one is still growing. Do you recommend that I split it up, or should I sell all at once even though one is not mature? Good question. We touched on this earlier. So this happens sometimes, and we get inquiries from people who might want to sell their lower performing schools, or they might want to sell their mature schools and keep the ones that are not mature. My answer would really be based around how strong the market is. So in the past, I would have said, sell what's mature and performing, get the others to maturity if you still have the energy. We certainly have sellers at times that will say, get me out of here, somebody else can do that. And that's okay. That's their choice. But historically, we would have said, you create the cash flow, and then someone will pay you based on that. You guys heard me say that just in the last, I'm not even sure I can say it's 12 months. It's probably 6 months. We have gained value for people for schools that are not mature. They're still ramping, and they've got cash at closing for those. So I feel like we're in a little bit of a high right now. Will that continue? Who knows? If it does, will it continue forever, or do we have a 6 to 9 month frenzy going on like most of our buyers are talking about? So who knows? I will say that strength is in the numbers, like I said. So when we talked about the factors of the multiple, you saw what a difference it makes if you have more than one school. Another advantage of that is if you have 2 or more in a market, it would encourage a buyer to come into that market that isn't there already, that might not want to come in for just one school. It used to be that number was 5, then it was 3, now it's pretty much 2. And again, that's just an indication of the strength of the market and how aggressive buyers are right now. But good question. Okay, this one is around owner expenses, and I said, okay, I said that I think I can take 2 more questions. So let me take this one. I see one more that's interesting. Okay. Does the multiple increase with majority of teaching staff that are degreed, certified teachers in years with the school? 10 plus is an example that would be staying on with a new owner. Yes, absolutely. So I'm not sure, I think it would softly play into the multiple, and it's just part of quality of curriculum and operation. So it's one of the many factors that go into looking at the quality. In today's environment with staff that's difficult to keep for a long time, if the staff was all brand new, that would certainly concern someone, and I think that would drive the multiple down. If there was a combination of some long-term staff and some newer, less than 2 years team members, that would, in this market, that would be considered perfectly normal. And I don't think a buyer would have a problem with that. So it's not a single factor that reflects a change in a multiple, but it is a factor in the quality of programming and curriculum that would certainly increase the multiple. And you can take that so far, though, as sometimes we'll have a seller and they have 30-year people. Obviously, they're very loyal to their owner, and they've been together a long time, and that might even be a concern to a new buyer. So a buyer is going to want to weigh the relationship strength, the risk associated with change once they take over. Can I make these people happy? Can I continue to operate with them? Will that impact the family base? So that's the thinking. But if you've got a lot of people that are degreed and certified and excellent in the school around the 10 or plus years, that would be viewed as a very big benefit. So good question there. The other one was, how do I justify the personal expenses? So what I mentioned was that if you have personal expenses in your school, that's okay. We can remove those. How do you justify those? That's pretty simple usually, and it's different means. So let's say it is a salary. You would typically have a W-2. We also add back the payroll taxes associated with that, which we calculate. If you own a car and you have certain expenses, gas, I recommend to people that they have a personal credit card and a company credit card. So if you have personal expenses, it's just easy to have them all associated with one credit card. But as long as you can show a receipt, you're good to go on the personal expenses. Other things, so this is one to mention real quickly. We have a lot of sellers who will talk to us about food, and maybe they take food home. So, food should be 6%, but it's really 10, but we're buying our own food. That one's really difficult. So unless you have a separate credit card again, and you're buying your personal food with that, and I'm not making judgments, but, it's probably not deductible, but that's for you and your accountant to figure out. But just be sure that you have separate mechanisms for personal expenses and business expenses. Same thing again, if you're going to buy a business, you want to prove to yourself that you're going to make the same amount of money or more money in the go forward. So I went over 1 minute. Those were terrific questions. You guys hung right in there with me. It was a big crowd, and I appreciate it. Join us on Thursday, October 17th, 2 weeks from tomorrow. We'll talk about real estate valuation, and we'll get into that. Between now and then, I'll figure out a way to make that simple and understandable. Take care and reach out to the team if there's anything we can do in your particular situation. Thanks so much.